Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
All right, so today we're digging into the Q3 2025 results, and what's really standing out, I think, is this pattern.
You mean the consecutive beats?
Exactly. This is the fourth quarter in a row where the execution seems to have, well, landed ahead of what they guided. Management's really framing this as proof,
Proof that the big strategy shift is actually working.
That's the narrative, that this multi-year pivot, it's taking hold. There's definitely momentum building.
Okay, so for you trying to get your head around this whole transformation, we're going to focus on, three main things that jumped out for the materials?
Yeah, three big pillars. First, there's the balance sheet. They've really beefed it up, calling it a war chest, actually.
A war chest, okay. Aggressive term. What's the second pillar?
It's the Core by 86 business, which, kind of surprisingly, is getting a real boost, accelerating even. Seems AI is the catalyst there.
Interesting. So AI isn't just about new chips, it's helping the old guard too.
Yeah, very much so. And then third, critically, is the Foundry initiative. It's still, costing a lot, but they're making undeniable progress.
Right, the long game. We need to look at those new nodes, 18A and 14A.
Exactly. And also the mindset shift, going from just making their own stuff to being a reliable service provider for others. That's huge.
Okay, let's start with the numbers then. Q3 performance, you said above guidance.
Yeah, across the board, really. The top line revenue came in at $13.7 billion.
13.7. How's that sequentially?
That's up 6% from Q2 and comfortably above the high end of what they'd signaled.
Okay, solid revenue beat.
Yeah.
But you mentioned something else was maybe even more noteworthy.
The gross margin, non-GAAP gross margin, hit 40%.
40%, wow. That feels like a big psychological barrier crossed, given where they've been.
It really does, and it was 4 whole percentage points better than their own guidance.
So where did that upside come from? Just selling more?
It was a few things working together. Higher revenue, yes, that helps spread the fixed costs, but also a better product mix.
Meaning selling more of the expensive high-margin chips.
Exactly. Plus, they seem to be keeping a tight lid on costs. Continued discipline there, even as revenue climbed.
And that flows down to the bottom line, presumably. Did earnings surprise too?
Oh, absolutely. Earnings per share, EPS, landed at $0.23. 23 cents.
Against guidance of?
Guidance was basically break-even, zero.
Okay, so swinging from an expected zero profit to 23 cents per share. That really shows the leverage, doesn't it? Volume, mix, cost control, all clicking.
It really underscores that operational leverage they managed to find this quarter.
All right, let's unpack that war chest idea. It sounds like building this up was a major focus starting back in March.
Definitely. It's all about getting the cash position and liquidity sorted. And the scale is, pretty immense.
How much are we talking?
They've managed to secure roughly $20 billion in total cash inflows this year.
$20 billion?
Yeah.
Wow, where did all that come from? Just profits.
Oh, no, this is through specific deals, equity sales, government money. It's really about building that runway.
They run it for
funding the Foundry build-out. That's a multi-year, multi-billion-dollar effort. This cash ensures they can do it without, starving the core business.
Okay, $20 billion. Can you break down the big pieces of that?
Sure. The sources are pretty diverse, which is interesting in itself. The biggest chunk was $5.7 billion from the U.S. government.
Right, the GPS Act funding coming through.
Exactly. That's foundational for the domestic manufacturing push. Then they got $2 billion from SoftBank Group.
Right.
Another $4.3 billion came from closing out the Altera division stuff.
Restructuring their freed up cash. Makes sense.
And about $900 million from selling down some of their Mobileye stake.
So government support, strategic investor, asset restructuring, partial stake sale. Quite a mix.
And we're not even done. There's still that NVIDIA investment expected.
That's right, the partnership deal. How much was that again?
Another $5 billion expected from NVIDIA, and that's supposed to close by the end of Q4, so pretty soon.
Okay, so add that in, and you're looking at a massive liquidity improvement in less than a year. Are they just sitting on this cash or paying down debt too?
No, they're definitely managing liabilities. They paid back $4.3 billion of debt just in Q3.
$4.3 billion.
Yeah, and they specifically said deleveraging is a priority. Paying off debt that matures in 2026 seems to be the focus there. Fiscal prudence alongside the big investments.
Let's go back to the government support for a second. It's more than just cash, isn't it? It feels like a strategic statement.
Oh, absolutely. Management is leaning heavily on that. They keep emphasizing they're the only U.S.-based company with the whole package leading-edge R&D and high-volume manufacturing.
End-to-end capability.
Right. And the government support, they frame it as recognition of that strategic importance. It's about revitalizing semiconductor production here, reducing reliance on Asia.
And that government backing must help de-risk the massive foundry spending in the eyes of investors.
You'd have to think so. It signals alignment, a shared strategic goal, makes those CapEx numbers maybe a little easier to swallow.
Okay, shifting from external factors to inside the company. There was talk about internal execution improving and a cultural shift. Right-sizing.
Yeah, a pretty significant internal effort.
Yeah.
Two main goals they mention, getting the company structure right and consciously changing the talent mix. Both aim to be done by year end.
What does right-sizing mean in practice? Fewer management layers.
That seems to be part of it. Optimizing management levels, getting rid of duplication, especially across those horizontal engineering functions. And underpinning it all, they stress this return to an engineering-first mindset.
Engineering first. That sounds crucial if you're trying to pull off something as complex as the Foundry roadmap. Are they seeing signs it's working?
They claim to be. Management specifically mention a positive shift in energy and collaboration day to day.
And they attributed that to.
Believe it or not, the return to office policy. Yeah, they're saying having people back physically, that immediate communication, is helping them solve problems faster, make decisions more coherently. Which, you need that speed when you're trying to ramp difficult new process nodes like 18A.
Interesting. It's a direct link they're drawing between physical presence and execution speed on complex tech problems.
Seems so. An acknowledgement that some things are just harder to do remotely when you're dealing with bleeding-edge hardware development.
Okay, so if that improved culture is helping stabilize operations. Let's move to part two. The core markets, the products, and this AI catalyst you mentioned. What's the big insight about AI and traditional compute?
Well, what's fascinating, I think, is the realization that AI isn't just about needing brand new, super specialized chips. It's actually driving a huge need for more traditional x86 compute, too.
How so? Doesn't AI run on GPUs and accelerators?
It does, for the heavy lifting, the training, but think about everything around that. Deploying AI models means generating, storing, moving, and managing massive amounts of data. Tokenization, data pipelines, running the actual applications. That all relies heavily on existing cloud infrastructure edge devices.
Which are mostly running on?
Mostly x86. From the cloud right down to the edge. So AI is actually forcing a big refresh and expansion cycle for standard CPUs, too.
So the fact that x86 has been around forever, has this huge installed base, that's actually an advantage now.
It's a massive advantage. You've got unmatched compatibility, security familiarity, developers know how to use it, it's flexible. And because it's everywhere, it's perfectly positioned for these hybrid compute environments that are emerging.
Hybrid environments, like mixing cloud and local processing.
Exactly, especially for things like inference at the edge or these new agentic systems people are talking about.
Agentic systems. Okay, unpack that for us. How's that different from just running an AI model in the cloud? And why is x86 good there?
So agentic AI is more about specialized programs, agents that act kind of semi-autonomously to get things done. Think robots on a factory floor, smart monitoring systems, complex local simulations.
Stuff that needs to react fast, locally.
Precisely. Unlike a big language model just answering queries from a data center, these agents need constant, low-latency interaction with the real world. They can't always wait for a round trip to the cloud.
And x86 provides that local processing power reliably.
Yeah, especially the newer chips like the Core Ultra family that have AI acceleration built right in alongside the standard CPU cores. They offer that blend. Compatibility, good memory access, integrated AI features. It's ideal for those localized, always-on workloads.
Got it. That context helps. So let's look at the client compute group, CCG, the PC side. Sounds like they had a good quarter.
They did. CCG pulled in $8.5 billion in revenue.
8.5. How does that compare?
Up 8% quarter over quarter. Pretty strong momentum. And it seems to be driven by a few tailwinds all hitting at once.
Like what?
Well, first, just the basic PC refresh cycle. We're about 5 years out from that big surge in PC buying during early COVID. So lots of older machines out there ready for an upgrade.
Makes sense.
What else? Second, the ongoing Windows 11 migration, especially in businesses. Enterprises are still rolling that out.
Still, wow.
And third, you're starting to see real, tangible adoption of AI PCs. PCs with those NPUs, neural processing units, baked in. Early days, maybe, but it's starting.
And the target for AI PCs is pretty ambitious, right? Something like 100 million?
Yeah, they're aiming for 100 million units shipped with their AI tech by the end of this year. It's a huge push, but
Wow.
there's a catch.
What's the tension?
It's a fascinating supply chain problem they highlighted. While they're pushing hard to ramp up the new AI-enabled chips Lunar Lake, Arrow Lake customers are still demanding tons of the older stuff.
Older stuff like?
Like Raptor Lake, proven chips. For many customers, especially businesses just doing the Windows 11 upgrade, those older chips are perfectly fine and probably cheaper.
So they're trying to build a future while the present is still clamoring for the past.
Exactly. And the past, the Raptor Lake demand, is highly profitable. But the future, the new AI PC chips, are on new processes, they're expensive to make initially, yields aren't perfect yet, so they're juggling, trying to satisfy that profitable legacy demand while shifting precious manufacturing capacity to these new high-cost, early-yield AI products.
That sounds challenging. And probably ties into the supply constraints we'll get to later.
Definitely. It speaks directly to why supply is tight.
Okay, beyond the current Core Ultra chips, what's the longer-term plan for notebooks?
Still very aggressive. They're saying they're on track to launch the very first Panther Lake 6U by the end of this year.
Panther Lake, that's the next big thing, using the newer process nodes.
That's the plan. First one this year, then more Panther Lake options rolling out in the first half of 2026. The goal is clearly to keep cementing their leadership in notebooks, which is just a massive, crucial market for them. A cash cow, really.
And what about the desktop side? Competition there always seems fierce.
Oh, it is. Fiercely competitive. They said Arrow Lake shipments are ramping up now, but the next big step they're planning is Nova Lake.
Nova Lake. What's the pitch there?
Sounds like significant architectural upgrades, software improvements too. They specifically mentioned targeting the high-end PC gaming segment with it. You know, the Halo products where performance leadership really matters for brand perception and lets you command higher prices.
Right. Got to win the benchmarks in gaming. Okay, let's pivot to the other big group, data center and AI, or DCAI. Q3 revenue was $4.1 billion.
Yep, $4.1 billion, up 5% sequentially.
What drove that growth? Just general cloud spending?
It was a mix. Better product mix again, selling higher value server chips, and definitely stronger demand from enterprises, specifically linked to building out AI infrastructure.
So again, it's not just about the fancy AI accelerators. The CPUs are critical too.
Absolutely critical. You need more than just the training chips. Building out AI means massive data, needs tokenization, storage, retrieval. Plus, data centers are hitting real walls with power and space.
Power and space constraints? That's huge for data centers.
It really is. And the traditional CPU, the Xeon, is still the essential head node, as they call it. It orchestrates the whole thing, manages the data traffic flowing to and from the accelerators.
And they're pushing an efficiency story with their latest Xeons, right? The Xeon 6?
Very much so. Xeon 6, codenamed Granite Rapids. They're really positioning it as the go-to CPU for the AI head node, especially for the big hyperscalers. The key metric they hammered on was TCO, total cost of ownership.
How much better is it?
They claimed that compared to the average server currently installed out there, moving to Granite Rapids could save customers up to 68% on TCO.
68%. That's enormous.
And maybe even more importantly, given the power constraints, up to 80% less power consumption.
80% less power. Wow. In these energy-hungry AI facilities, that must be a massive selling point.
You bet. That efficiency message is powerful right now.
And is this efficiency, this AI demand, changing how customers buy server chips?
It seems to be causing a fundamental shift. This was a really key insight, I thought. Customers, especially the big hyperscalers, are showing much more interest in long-term strategic supply agreements.
Moving away from just buying on the spot market.
Exactly, because building out this AI infrastructure is so rapid, so sustained, and so capital-intensive, they need certainty. They need guaranteed supply, stable pricing. So they're shifting from just transactional buying to forming deeper, long-term partnerships with chip suppliers they trust can deliver the volume.
That makes sense. They need the lock-in capacity. Which brings us neatly to that unexpected partnership, the one with NVIDIA.
Yeah, that definitely raised some eyebrows. But strategically, it seems like a recognition of reality. The market wants integration.
So they're combining Intel's CPU strength with NVIDIA's GPU dominance.
That's the idea. Combining their x86 leadership, the core server brain, with NVIDIA's massive strength in AI and accelerated computing through their GPUs.
How are they actually connecting them? Is it just software, or...?
No, it's hardware level. The plan is to connect the architectures using NVIDIA's NVLink.
NVLink, okay, that's NVIDIA's high-speed interconnects.
Right. That should allow them to create tightly integrated, multi-generational products. For hyperscalers initially, then enterprise, maybe even consumers down the line. It's a complex engineering job, requires really tight co-design to get data flowing efficiently between the CPU and the GPU complex with minimal delay.
Now, they were careful to call this partnership incremental. Why that specific word?
It's important positioning. It means they see this not as fighting NVIDIA for existing business, but as growing the whole pie.
Expanding the market rather than stealing share.
Exactly. By integrating this tightly, they believe they can create new classes of products optimized for specific workloads that need both strong CPU and strong GPU capabilities working seamlessly. It keeps the x86 platform relevant and central even in the fastest growing parts of the computing market. It's like acknowledging that even the most powerful accelerators need efficient host CPUs to feed them data.
Okay, so that's the high-end training and massive acceleration covered by the NVIDIA link-up. What about the broader AI accelerator market, especially inference?
The focus there is shifting heavily, decisively towards inference. Management was really clear on this. They believe the inference market thinks agentic AI, physical AI, all those edge applications is ultimately going to be far larger than the initial AI training market.
So the strategy is to own the inference platform.
To be the indispensable compute platform for inference, yeah. And that means partnering.
Partnering with?
With everyone, basically.
Yeah.
Established players, emerging startups who are defining this space. And on their own product side, they committed to an annual cadence of new GPUs specifically optimized for inference.
Inference-optimized GPUs, what does that mean? More memory?
Enhanced memory, definitely.
Right.
More bandwidth. Tailored to handle the kind of high-volume, often lower latency demands you see in enterprise inference compared to the massive calculations needed for training.
Okay, one more piece before we hit the Foundry. This new central engineering group, what's the goal there? Sounds like internal streamlining.
It is, primarily. It's about unifying all those horizontal engineering functions that cut across different product groups. Things like IP block development, standardizing on EDA tools, common design platforms.
Trying to stop different teams from reinventing the wheel.
Exactly.
Yeah.
Eliminate duplication, enforce common methods, make decisions more coherent, which you absolutely need if you're trying to launch multiple complex products on multiple new process nodes all at the same time. It imposes discipline.
But wasn't there an external angle too? Something about a new business.
Yes, and this is a really interesting pivot. This central group is also going to spearhead a new business line, offering ASIC and design services to external customers.
So designing custom chips for others.
Pretty much. Leveraging their internal design expertise, their library of IP blocks, including Core x86 IP, potentially to build purpose-built silicon for other companies. It's a way to potentially monetize their design skills and IP portfolio, and maybe drive more business to their own foundry eventually. A design house for hire, essentially.
Okay, that's a significant move. Right, let's make the transition now to part 3. The Intel Foundry. This is the big one, the long-term transformation. What's the latest on progress with the leading-edge nodes? Starting with Intel 18A.
Okay, 18A. They're saying progress is steady, hitting the milestones.
Sure.
Critically, Fab 52 down in Arizona is fully operational now for high-volume manufacturing on 18A.
And products using it.
Yep.
Still on track.
Yes, they reiterated that Panther Lake, a major client chip, is still on track to use 18A this year. And maybe just as important for external customers, they're hitting key PDK milestones.
PDK, Process Design Kit. Why is that so crucial?
The PDK is basically the instruction manual, the rule book, that designers use to create chips for a specific process node. Hitting the P version 18AP, the production version signals that the design rules are stable, the computer models are accurate. It tells customers, okay, this process is ready. You can confidently submit your final designs, what they call tape out.
Reduces the risk for customers betting on this new node.
Exactly. And Intel is betting heavily on 18A themselves. It's supposed to be the foundation for several generations of their own chips, well into the 2030s, so getting it right is paramount.
Okay, that's 18A. What about the next node after that, Intel 14A?
Engagement there has picked up quite a bit since the last update, which is positive. More customers are kicking the tires. Right now, the focus is on defining the technology details, the specific transistor architecture, and really nailing down the IP requirements those lead customers need for 14A.
They also made a comparison between 14A's current maturity and where 18A was at the same stage. What was the claim?
They claim that 14A is actually showing better yield and performance maturity right now than 18A did at the equivalent point in its development cycle.
Better than 18A was. Is that genuinely reassuring or just expected learning curve improvement?
Probably a bit of both. Its good news internally suggests they are learning from the 18A ramp, which was a huge transition. Remember, going from FinFET to the new RibbonFET transistor. So maybe 14A involves fewer fundamental leaps, allowing for a smoother development. But yeah, it boosts internal confidence. External customers will want to see the hard data, of course.
Of course. This all leads into the investment philosophy for the Foundry. You mentioned disciplined CapEx. How does that square with the war chest we've discussed?
Right, this is where it comes together. Running a foundry is fundamentally different. It's a service business. You live and die by customer trust, hitting yield targets, being reliable, meeting schedules.
Can't just build it and hope they come.
Exactly. That's the classic chicken and egg problem for foundries. Do you build the expensive fab first, hoping customers show up? Or wait for orders and risk not having capacity? Their stated philosophy is very clear on this.
Which is?
No major new capacity investment unless they have committed external demand locked in.
So, the war chest isn't for speculative building.
Apparently not. It's there to enable the spending when the orders are signed. It de-risks the timing. They have the funds ready, but they're showing discipline by not pulling the trigger on massive new greenfield fabs until customers commit.
Okay, but how do they handle the initial external customers then? If they need some capacity to prove themselves, but aren't building huge new fabs yet?
That's the clever part, or so they say. They talked about having flexibility right now. They can apparently meet a reasonable amount of initial external demand by using assets already on the books, stuff listed as assets under construction.
So finishing projects already started.
Seems like it. And also reusing existing equipment where possible. So the idea is they can onboard those first few crucial foundry customers, start building that trust and demonstrating capability without having to immediately break ground on entirely new multi-billion-dollar facilities funded purely by hope.
It's smart. But the underlying potential demand must be huge to justify this whole foundry strategy long term.
Oh, it's astronomical. And it's almost entirely driven by AI infrastructure build-out. They use the term unprecedented demand for both wafer capacity and advanced packaging.
Advanced packaging too, right? Not just the chips themselves.
Critically important. The projections they cited suggest we'll need more than a 10x increase in the gigawatts consumed by AI data centers by 2030. That translates into enormous demand for cutting-edge silicon and the complex ways to package it.
And they feel they have an edge in packaging.
They definitely highlight it as a differentiator against the pure-play foundries. They specifically mention progress with EMB. That's their bridge technology for connecting chiplets side by side, and EMBT, presumably a through silicon version. This ability to mix and match different chiplets, maybe from different process nodes, into one package is key for complex AI chips. Heterogeneous integration, they call it.
Okay, let's ground this in the current financial reality.
Yeah.
What did the foundry segment actually report in Q3? Revenue, profitability, or lack thereof?
Right, the numbers. Foundry revenue in Q3 was $4.2 billion. That was actually down 4% sequentially.
Down. And the operating loss? Still significant.
Very. Operating loss was $2.3 billion for the quarter.
$2.3 billion loss. Ouch. Was that better or worse than Q2?
It was an improvement sequentially, but mainly because Q2 had a big one-off impairment charge, about $800 million, that didn't repeat in Q3. So the underlying loss is still substantial.
Clearly, those margins need to improve drastically as they scale. When do they expect the foundry, particularly these new nodes like 18A, to actually start helping overall company margins instead of hurting them?
They were pretty direct about this financial hurdle. Long term, they need scale and a shift towards selling more of those advanced higher value nodes like 18A and 14A. Right now, they said the yields on 18A and 14A are good enough to supply their internal needs.
But not good enough to make money selling externally yet.
Exactly. Not yet at the level needed for margin accretion, for actually boosting the company's overall profitability. They gave a specific timeline, though. They expect 18A yields to reach an industry-acceptable level, their words, by the end of 2026.
End of 2026. Okay, so that implies these leading-edge nodes will likely continue to be a drag on overall gross margins for, what, the next 2 years or so?
That seems to be the implication. Until late 2026, the ramp-up costs and lower initial yields will likely pressure the corporate average margin, even if other parts of the business are doing well. It sets a very clear time frame for when the financial benefits of the foundry are expected to really kick in.
A 2-year clock. Got it. Okay, let's shift gears to part 4, the near-term picture. Despite all the positive long-term strategy talk, there are immediate challenges, right? Supply constraints seem to be a big one.
Yeah, this is the reality check. Supply is tight, pretty much across the whole business, they said. But specifically on some of the older workhorse nodes like Intel 10 and Intel 7.
The ones used heavily for PC chips.
Right. And it's not just their own wafer capacity. They also mention industry-wide issues like shortages of substrates needed for packaging the chips.
So even if they make the silicon, they might struggle to package it.
That can be a bottleneck too, and they were clear. This tight capacity actually limited how much more they could have sold in Q3. It capped the upside. And they expect these constraints to stick around well into 2026.
Persisting into 2026. Okay. So given they don't have enough supply for everything, how are they deciding what to build and ship in Q4? Prioritization.
Very deliberate prioritization. For Q4, the forecast is for the client group, CCG, revenue to be down slightly from Q3. But the data center group, DCAI, revenue is expected to be up strongly.
So servers over PCs.
It looks like it. They're clearly prioritizing using their limited wafer capacity for the higher value server chips over the entry-level, lower-margin client parts. Makes sense from a profit perspective when supply is constrained. Maximize revenue and margin from the wafers you can produce.
When do they see these shortages peaking? Do they give any sense of that?
They did offer a forecast, which was interesting. They suggested Q1 of 2026 might be the peak period for the shortages.
Q1 2026. Why is that significant?
Well, Q1 is usually a seasonally slower quarter anyway after the holidays. If shortages are also peaking then, it could really challenge those normal seasonal patterns. They might simply not have the inventory, especially in low-end client, to meet whatever demand is there, potentially making the seasonal dip even worse.
Okay, something to watch early next year. What about the specific guidance for Q4 then? Revenue range.
Revenue forecast for Q4 is between $12.8 billion and $13.8 billion.
12.8 to 13.8 billion. How does that compare to Q3, adjusting for Altera being gone now?
Yeah, good point. If you adjust for the Altera deconsolidation, the midpoint of that Q4 range suggests revenue is roughly flat compared to Q3, so not growing sequentially on an adjusted basis.
Okay, flat adjusted revenue. What about gross margin? You said Q3 was 40%. What's the Q4 forecast?
Significantly lower. Forecast is around 36.5%.
36.5. Wow, that's a big drop from 40%. Why the decline after such a strong Q3 margin?
They pointed to three main reasons, three headwinds. First, just a less favorable product mix expected in Q4 compared to Q3.
Okay, mix shifts quarter to quarter. What up?
Second, and this is pretty specific, the initial ramp costs for a new product. Core Ultra 3.
Ah, the cost of launching new tech.
Exactly. New products, especially on new manufacturing processes, always start with lower yields, higher costs. It takes time to climb the learning curve. So launching Core Ultra 3 will temporarily pull down the average margin.
Makes sense. And the third reason, does it relate to the balance sheet stuff?
It does. The third factor is simply the deconsolidation of Altera.
How does removing Altera hurt margins?
Because Altera historically was a high-margin business for them. Its margins were better than the overall company average. So when you take that profitable piece out of the consolidated results, the remaining blended average naturally drops, even if the other parts are holding steady or improving slightly.
Right, losing that accretive piece pulls the average down. Got it. Okay, fine, looking ahead again. Investment discipline, are they sticking to their CapEx and OpEx targets?
Seems so. They reiterated the 2025 gross CapEx target is still $18 billion.
$18 billion, that's just gross CapEx.
Yeah, they mentioned overall capital investment for the year would be over $27 billion, which is a huge jump from the $17 billion they deployed in 2024. Shows the sheer intensity of this build-out phase.
Massive spending. What about operating expenses, OpEx, looking into 2026?
The goal for 2026 OpEx remains $16 billion, but they emphasize they're constantly reviewing how that's spent, trying to optimize the mix, put money where the highest return is, discipline even during the rebuild.
And any guidance on things like non-controlling interest for modeling?
Yeah, for 2026, they expect NCI non-controlling interest to be somewhere in the $1.2 billion to $1.4 billion range.
Okay. So pulling it all together, it's a complex picture, isn't it? A massive strategic overhaul on multiple fronts. Stabilize the finances, get the cash.
Check. Use AI to give the Core by 86 business new life.
Check. And then this enormous, expensive, culture-shifting bet on becoming a major foundry.
Right. It really is a journey of rebuild, as they put it. The confidence, I think, comes from seeing these pieces as interconnected. The Foundry helps the core business long-term. The core business funds the Foundry now. The new ASIC unit uses Foundry capacity. It's meant to be reinforcing.
So thinking about the big picture again, and that point you made about data center customers wanting long-term deals, what does that tell us about the AI era and the chip market?
I think it's potentially transformative. That shift towards demanding long-term strategic supply agreements,
Yeah.
it suggests a fundamental change in behavior. Building AI infrastructure is just so huge, so expensive, relies on such specific, power-hungry tech. Customers simply cannot afford uncertainty about supply.
They're not just buying parts anymore, they're buying future production capability.
Exactly. They need certainty. They need suppliers they can trust, who can guarantee the capacity will be there years down the road. It forces a move away from purely transactional, price-based relationships towards these deeper strategic partnerships built on mutual commitment and long-term predictability.
And that predictability is what allows the suppliers to confidently make those huge multi-billion-dollar CapEx bets and the customers to confidently plan their massive AI rollouts. It becomes almost symbiotic.
It really does seem to be heading that way, which leads to maybe a final thought for you listening.
Go on.
If the sheer scale and intensity of building for AI is forcing this kind of deep strategic commitment between the biggest customers and their chip suppliers now, how quickly might that model, the long-term locked-in supply agreement model, spread beyond just hyperscalers and CPUs, GPUs? Could we see it reshape relationships for other critical tech components, maybe even into other industrial sectors? Is this the future of strategic sourcing for complex, capital-intensive technologies?
That's a fascinating question. A potential restructuring of supply chains driven by the demands of AI. Definitely something to mull over.
Indeed.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.